Hello everyone, welcome to Chapter 8. Chapter 8 is our last topic of this semester. In this chapter, we're going to look at receivables and pay most of our attention and spend most of our time on bad debt expense and the accounting analysis, measurement, recording of bad debt expense. And then in the end, we're going to look at the idea of calculating and recognizing, recording interest revenue. So the first learning objective is to look at the pros and cons of extending credit to our customers. Remember, we say that modern accounting, or the financial accounting system that we are learning in this course, is accrual-based accounting. That is, recognizing revenue is not the same as receiving cash, at least not in the sense of the timing. On the other hand, recognizing expenses does not happen in the same time, does not necessarily happen in the same time period of paying cash out. So the pros and cons, or the trade-offs of extending credit to our customers. So I want you to think for a second or a moment, what are the benefits of doing that? And what are the potential problems or pitfalls of extending credit to our customers? Our analysis here is based on the compare and contrast between credit sales and cash sales. Okay, so if you think about it, cash sales, it's kind of straightforward, right? Customers pay cash on the spot. We deliver the products or the service to the customer on the spot, and that's it. If you think about the accounting treatment of that, there will be debit, cash, receive cash. So debit, cash, X amount, credit, we recognize revenue, credit, sales revenue, or revenue, X amount. That's it. However, a lot of businesses extend credit to their customers. So the most important and fundamental reason for businesses to do that is to increase their sales, right? To sell more stuff to their customers, to compete better than or compete against their competitors. However, this practice of extending credit could cause some problems. On one thing, just because you recognize revenue and booked accounts receivable in your account books doesn't necessarily mean you're going to receive cash payment, 100% of that. So there's a problem of bad debt costs. Inevitably, or as a certain percentage, some customers will not be able to pay you the cash they promised to pay. So that's the bad debt cost. Then if that happened, you have to collect from the customers if they're late on their bill, and then eventually you might have to write the bad debt cost off. Obviously, that's a disadvantage. And then from the accrual perspective, in period 1, you record accounts receivable, and period 2, you receive cash payment from the customer. So there's a time difference, or there's a lag between you sell the customer the products or the service, and you get paid from the customer. So there's a delayed receipt of cash. We mentioned the idea of cash position before. If you are receiving cash late, there could potentially be some kind of strain on your cash position. We know money has a time value. $100 today in hand is better than $100 a week from today. better than $100 a month from today. So delayed receipt of cash could cause problem. And on top of the two advantages we just mentioned, you could also incur extra costs as related to credit sales. First of all, you're not going to extend credit to anyone. Hopefully, most likely you have some kind of a system in place to check the credit worthiness of the customer. For example, if you're a bank who's extending mortgage loans to your customers, then of course you have a very extensive process of the customers to make sure they will be able to pay you back the principal and the interest. Similarly, in our case, you don't want to extend credit just to anyone walk through the door. That's why we have those credit scores for individual consumers. And then for businesses, the bond of the business have, say, ratings, right? Above triple B, that's investing grade. Lower than triple B for one system, that's junk bond. So cost of investigating the credit worthiness of customers, cost of tracking the accounts receivable, and then cost of having those professionals, staff, managers of doing that. Those are the wage costs. So that's our first topic. Look at why do businesses extend credit to their customers, and the benefits and the potential problems of doing that. Our next learning objective is to look at the effects of uncollectible accounts, to estimate and report the effects of uncollectible accounts. In previous chapters, we already mentioned that a lot of concepts and ideas, including revenues and expenses, are based on a systematic estimate. So here, we're going to see that concept one more time. That is, how do we decide what's the amount of uncollectible accounts? So let's look at a diagram, kind of depict the sequence of events that typically happened and then the timeline of the events. So let's assume on January 1st, we record sales revenue, and also here we basically recognize revenue based on a credit sales. Credit sales again means we sell the stuff to customers, we recognize it as revenue, but we don't get paid right away. Instead, we put it on our accounts receivable. So January 1st, debit accounts receivable, that's an increase in asset, goes on debit, and then credit sales revenue. Remember, revenue increase goes on credit side. And then both, one of them is a balance sheet account, that's an asset, that's accounts receivable. Another one of them is income statement account, that's sales revenue. Okay, so we have learned this. Second, by the end of the month, let's assume that's the period, the accounting period, by or before January 31st, we have to estimate bad debts. Here is the match principle is working here. Match principle means we have to match the expense to the revenue in the same period, to match the expense with the revenue that quote unquote it generates. Because why do we have potentially and sometimes inevitably, why do we have bad debt expense? because we sold stuff to customers on credit. So the bad debt expense is caused by this credit sales revenue. So we have to recognize the bad debt expense in the same period as the revenue incurred. However, some of you may already realize that, but the bad debt expense has not actually happened yet. That'll be a very good question, but let's just park that thought for now, because let's finish this timeline and the journal entries first, and then look at the methods of estimating the bad debt expense. So here, by the end of January, we estimate a bad debt expense. Expense increase goes on debit side, so debit, bad debt expense. Credit allows for doubtful accounts. That's good. And here, allowance for doubtful accounts is a new kind of account. It's a contra asset account. You notice there's an X, and then X stands for contra, and A is asset. So it's a contra asset. So the increase of allowance for doubtful accounts goes on the credit side because it goes against the asset when assets is on the debit side. Notice here, again, you will have an impact on both the income statement, which is the bad debt expense, and on the balance sheet, which is allowance for doubtful account. So the blue ones are corresponding with balance sheet, the red ones are with income statement. Alright, so assuming after the current period, after January 31st, the actual event and the amount of bad debt become known to us. Here, our journal entry would be debit allowance for doubtful accounts, credit accounts receivable. If you notice, this is only about balance sheet account. It reverses the allowance for doubtful accounts account. It also reverses back the accounts receivable account. And if you think about it, because both the debit and the credit only affect the balance sheet, as a result, the event of bad debt actually happened and became known to us does not impact the income statement when the bad debt actually happened. So the impact on the balance sheet already being recorded in the same period as when we record the sales revenue. When bad debt actually happened, it's recorded the next period, but only on the balance sheet. So that's one thing I want you to be very careful with. Okay, so that's the timeline, and I'm running near my 15 minutes limit here. So take a short break. Go back to the timeline and make sure you understand the match principle dictates that we recognize bad debt expense in the same period as credit sales. And then we're going to, and then when bad debt actually happened, it only affects the balance sheet. Okay, so in the next one, we're going to look at the method, the allowance method.